What if you're concerned about market volatility and declines, but still want to remain invested in growth opportunities? With buffered notes, you can protect a portion of your equity portfolio and invest for growth with confidence. Before investing in buffered notes, you should ask yourself some important questions. Where do you want market exposure? Subject to the relevant offering documents, buffered notes are linked to the performance of an underlying reference asset, or underlier. Examples of typical underliers include a basket of stocks or equity indices. How long are you willing to commit your money? Buffered notes come in a variety of time periods that generally range up to 10 years. They are intended to be buy and hold investments that are held to maturity. The longer the maturity, the greater the likelihood the investment will have a wider variety of growth and downside protection features from which to choose. How much of your principal do you want to protect? Buffered notes provide downside protection by absorbing losses up to a predetermined level, or buffer, at maturity. For example, if you choose a 20% buffer and the value of the underlier declines by 10%, your losses are covered. However, if the underlier declines by 30%, the first 20% will be covered and you will lose 10% of your principal. Buffers typically range up to 40%. Given your risk tolerance or market view, you may prefer a buffered note that offers a larger buffer in exchange for lower potential upside. If you want to capture as much upside potential as possible, you may prefer a smaller buffer. What is your desired level of growth? Any positive returns are linked to the performance of the underlier. Dividends paid on the underlier are not passed through to the buffered note. Buffered notes provide the potential for growth based on a participation rate, the degree to which an investor can participate in the potential appreciation or growth of the underlier. Subject to the terms outlined in the offering document, the participation rate on a buffered note may be 100%. This means that for every 1% gain in the value of the underlier, your buffered note gains 1% in value. A participation rate over 100% is considered an accelerated participation rate. For example, a 200% participation rate means that for every 1% gain in the value of the underlier, your buffered note gains 2% in value. Additionally, there may be a cap on the upside, which would be the maximum return. Investors should review the relevant offering documents to understand the specific terms that may impact the performance of a particular buffered note. Any returns of principal, interest, and gains generated are subject to the credit risk of the issuer. If the issuer defaults on its payment obligations, the applicable amount of your principal could be at risk. It is important to note that there may not be a liquid secondary market, and the value of the investment may be worth less than the principal amount if sold prior to maturity. Learn how buffered notes allow you to set targets around your desired levels of risk and performance.